Coming up on today's show, stocks finish higher led by mega cap tech. Markets continue to believe the economy is heading for a soft landing. What to expect from the big jobs report tomorrow. Why BlackRock thinks volatility is coming back to markets. And Google shares up sharply after their Gemini AI announcement. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. Thanks for tuning in. My name's Jared. I'm going to get you all up to speed on everything that's happening across financial markets. And it was mostly a bullish day for the indices, led by mega cap tech. We had semis perform really well today, led by AMD up almost 10% on the announcement of their new chips to compete with Nvidia. And we also had a sharp increase from Alphabet Google after the announcement of their latest AI model. However, looking out across the rest of the market, once again, quite checkered breadth out there, with some further weakness in the oil and gas sectors and some spots of red in the consumer defensive sectors. And just looking at a daily chart at the S&P 500, we can see it's continuing to coil up. We couldn't break above yesterday's highs, still in this sideways pattern we've been for a few weeks now. And because of that stalling momentum, that's starting to create some bearish divergences that could still play out and give us a bit of a pullback here. And it was actually the Magnificent 7 mega cap tech that was the winning group today, up almost 2%, and that was largely thanks to Google. And we've still got the Russell 2000 holding on to its short-term uptrend pretty good here, not really showing any signs of topping just yet. So the market's still in this wait-and-see mode, most likely going into non-farm payrolls tomorrow. That could give us a breakout in either direction. But before we keep going in the charts, let's just look at some research and news out from today. And so there's quite a bullish consensus out there. Across the market, investors are largely position bullish again after we quickly flipped from really oversold into overbought territory in the matter of just a few weeks. And a lot of people are still calling for that Santa Claus rally to come, which is technically the last 5 trading days of the year and the first 2 trading days of a new year. And it's true, we do have a bunch of technical indicators saying the market does look good, on top of some good fundamentals like the better than expected Q3 earnings season and a significant drop in bond yields and the oil price as well, bringing down inflation expectations. It's definitely legitimate reasons for the bulls to get excited. And love him or hate him, FundStrat's Tom Lee did get it right this year. He was the most bullish across a dozen or so monitored Wall Street banks and research houses with his forecast. And he's come out with a big target for next year as well, saying the S&P 500 is going to rally to 5,200 by the end of next year, which is about 14% higher from its current level. He said he expects falling inflation to translate to lower interest rates and faster than expected a raising of financial conditions, which should boost corporate earnings and stock market valuations. He said the economy also probably avoids a recession next year, even if the labour market is going to be weak in the first half of the year. He said he believes much of the gains will come in the second half, and who knows, he could be right, because given the macro backdrop of the most aggressive Fed hiking cycle in history and the regional banking crisis back in March, which looked sure to push the economy into recession, even had Fed fund futures back then giving less than a 1% chance that the Fed would hike again, which they did another 2 times. And so this is a Goldilocks setup for the stock market. Inflation keeps falling, bringing the cost of capital down, increasing the relative attractiveness of stocks. And I'm sure the Fed is pleased with all of that as well. It's kind of exactly what they wanted without anything major breaking. We're just seeing a little softness in the jobs market. However, just like the Fed implied that the bond market was doing its work for it over a month ago when yields were ripping up and the 10-year got over 5%, thus tightening financial conditions in the economy. It could now be having the opposite effect, like Mohamed El-Erian says, and could cause the Fed to delay rate cuts, as the market's pricing in of a Fed pivot could actually be delaying it from happening. And the market exuberance has the effect of loosening financial conditions, which could force the Fed to keep policy tight. And so basically with bond yields pulling back a lot and stock markets ripping up, that could create the grounds for inflation to tick back up. But like I've been saying, we'd need to see oil go back up for that to happen. And I'd say the Fed are very wary of this and definitely don't want to move too early and cut rates only to have egg on their face if inflation picked back up later on next year and having to do an about face and hike rates again. They really want to be sure that inflation is well and truly down to 2% before they can even think about cutting rates. And we should get a bit more of an idea on that tomorrow when we get the November jobs report out. First thing in the morning, 8:30 Eastern time. It's expected to show non-farm payrolls rose by 185,000 in November, with the unemployment rate expected to come in at 3.9%. And so that's a bit of an uptick on the previous reading we got of 150,000 new jobs, and unemployment at 3.9% is expected to stay the same. And like we can see here in this bar chart of unemployment rate, it may have bottomed out and has been turning up the last couple of months, in addition to the downtrend in the amount of new jobs the economy is generating. So the jobs market is definitely cooling and softening a little bit. And as long as it doesn't weaken too hard, too fast, the narrative of the soft landing will continue to remain intact, and it will very much be a manageable correction in the economy, and markets should really appreciate that along with the Fed. However, not everyone's so sure, with BlackRock saying investors should prepare for a long period of volatility as the US economy climbs out of its deep hole, saying investors could see high inflation, high interest rates, and a choppy market for a long time. Going on to say seemingly strong US growth actually reflects an economy that's still climbing out of a deep hole created by the pandemic shock and tracking a weak growth path. And they may be right, just looking at a long-term monthly chart of the VIX, with a simple sine line showing a little bit of cyclicality in the VIX in a roughly 2-3 year cycle. There was an unusual period from 2012 to mid-2015 where volatility stayed continually depressed. However, you got to remember during this period here, interest rates and inflation were at rock bottom lows. And so for the economy to adjust to these high interest rates and go back down to low rates, it would be truly remarkable if the VIX stayed depressed under these 15 levels for a number of years. And we very well could get a peak going into 2025, which wouldn't be all that unusual looking back in history. Even got some research out of JP Morgan saying 99% of Americans will be financially worse off than they were pre-pandemic by mid-next year. Also noting that elder millennials face a particularly tough set of circumstances. That's because the majority of Americans have burned through their excess savings piled up during the COVID pandemic, and in the coming months it's likely almost everyone will be worse off financially than they were in 2019. The bank's top strategist, Marko Klanovic, said 80% of consumers, a group that accounts for nearly 2/3 of consumption, has already depleted any savings cushion they may have built during lockdown. Going on to say consumers are facing tighter credit conditions and rising rates, wind down of COVID-era stimulus and relief programs, declining excess savings and liquidity, and multiple years of above-average inflation. And all that's hard to argue with, and once again, it would be truly remarkable if the economy and stock market can escape unscathed from that macro backdrop throughout next year. Moving on to commodities, we've still got some weakness in the price of oil, with the hopes of a bounce after the OPEC Plus meeting falling short and pretty much going unnoticed by the market, and threats by the Saudis and Russians of further cuts also falling on deaf ears. And there's a look at the daily chart of crude oil futures, putting in a little spinning doji here. Did find lows again today under $69 a barrel, and I expect it to come down and test these mid 67s where we may find some support there. And it's been quite the swift pullback considering it was only a couple of months ago in late September we're at $95 a barrel. And just staying on commodities, we've got gold coiling up as well in low volatility, a bit above $2,000 an ounce, and we're still yet to see whether this big reversal candle is going to play out or not, or whether it was actually just a bit of a bull shakeout. Also got signs of retail traders coming back into the crypto space. A lot of people betting on Bitcoin topping $50,000. We can see that in the growing amount of call options with a strike of $50,000 or more, with growing volumes across dealers and exchanges. And it's a story as old as time. Nothing changes investors' minds like price, but now that everyone's talking about it and it's across financial media headlines, we're probably due for a bit of a pullback here in Bitcoin, currently a bit technically overbought. However, I would still expect this medium-term trend to remain intact, and we could still get that big huge blow off top going into the listing of a spot Bitcoin ETF, just like happened in late 2017 as we were trading into the listing of Bitcoin futures. And this market's still really hanging its hat on the AI buzz. We can see that in the price action of Google shares today, up 5% after they announced its latest artificial intelligence model called Gemini, with Google executives saying Gemini outperforms OpenAI's GPT 3.5. And this is something the market had been worried about ever since we got ChatGPT earlier this year. Market was initially worried that Google couldn't keep up, and so they've been scrambling to invest and try and keep up and compete with Microsoft-backed ChatGPT. And it's hard to say how this does threaten this search engine model, because if you think about it, the old way of looking for information was doing a search and then flicking through a bunch of websites looking for their information. Whereas now you can just use ChatGPT, and it's like speaking to an expert in every topic out there. And I myself personally are already, for most of this year, using ChatGPT a lot more than Google, and there's no ads showing in ChatGPT. However, looking at the price action in Google today, gapped up on strong volume. It's not too far off year-to-date highs. Market seems to think that Google will be able to compete with GPT. However, it's still yet to be seen how they're going to monetize these chatbots and whether it will be as profitable as the traditional search results and the ads displayed in amongst them, in addition to the display ads on the websites that you visit. That is mostly a Google monopoly as well with their display ad network. So that's the software side of AI. Moving on to the hardware side of AI is AMD launching a new AI chip to compete with industry leader Nvidia. And it's got Microsoft and Meta backing it. It appears the market does believe the chip maker can take some market share from Nvidia. However, the company's projecting only $2 billion in AI GPU sales next year, whilst Nvidia expects to post more than $16 billion in data center sales in the current quarter alone, and that metric includes other chips beside AI GPUs. Citi analysts estimate that AMD could end up with about 10% of the total AI chip market. They believe the total market for AI chips could climb to $400 billion over the next 4 years. And some very nice price action in the shares of AMD today. After experiencing quite a bit of weakness mid-year up until last month, ever since earnings we've had a nice pop and some really strong volume coming into the stock today, finishing at the highs, just a few points away from year-to-date highs. And just looking at my stock fair value indicator, it's still reasonably valued. It's got fair value a bit higher at $173 a share, with a market cap of $207 billion, and that's versus Nvidia, which my indicator has fair value at $211 a share, quite a bit lower, with a market cap of $1.15 trillion. So AMD could well and truly be a formidable number 2 player in the AI chip industry, which is likely to grow pretty good over the next couple of years. And that gap between the market cap between those two players may actually close a bit based on current valuations and them likely to achieve similar growth rates going forward. Just looking at some economic data we got today, GDP growth rate year over year still flatlining in the Eurozone, showing they're still in an economic situation of stagflation, and their jobless claims out of the States came pretty much in line as expected today. Got some GDP growth data coming out of Japan in a little bit, and then the big one tomorrow will be non-farm payrolls. With the economy expected to generate 180,000 new jobs in November, unemployment rate expected to stay flat at 3.9%. I wouldn't be surprised if that comes in at 4% or even 4.1%. And the trend over the last month or so has been softer economic data has been helping the market rally and bond yields pull back. However, that could be changing, especially if we get a bigger than expected jump in unemployment rate and fall on non-farm payrolls. If the jobs market keeps softening just a little bit, the market's likely to like that, or at least consolidate. However, once again, we'll be paying attention to the market's reaction to the data and whether it's going to keep on liking this softer jobs market prints. But for now, the Fed Fund futures are still saying the Fed is done hiking rates, even growing a little bit of a chance they're going to cut next month, and about a 60% chance they're going to cut come March. And so some soft jobs market would reinforce those probabilities as well. And the stock market's still pretty comfortable here with the fear and greed index at 64, and still a growing gap with the corporate insiders selling stock versus buying stock. And just looking at my institutional buying percentage indicator, that's still just in the neutral zone at 46%. It is dropping. We've now got the S&P 500 oscillator dropping below the overbought zone to 57. That's starting to set up a bit of a divergence as well, just like we saw back here in July. The market kept creeping higher and the oscillator started ticking a bit lower. And just looking at my daily chart, it's a bit tricky to say here. The market is coiling up. We could get a move tomorrow on the jobs data. Still wouldn't be surprised if we get a pop up above to new year-to-date highs, especially if the data comes in a little softer than expected or in line. The market may actually really like that. However, if it would come in a lot weaker than expected, we could get a big red candle, as the market might start getting worried about a recession. It may not get a soft landing, because the narrative in the market now is a soft landing. So any data that points towards that not happening could be quite upsetting and coming out of this low volatility kind of stance it's in now. International stock markets are coiling up as well on low volatility. Got a bit of a drop in Japan's Nikkei, and volatility is pretty much sitting down there just above 13, with a little bit of volatility risk premium in the market from option dealers, and once again growing bond market volatility, and the spread between bond volatility and stock volatility sitting at all-time highs. Breadth was a little softer today, with new highs just slightly outpacing new lows, and mega cap tech continues to hold up growth versus defensive sector spreads, and there's still a bit of a growth rotation and high beta stocks versus low volatility, along with strength in consumer discretionary versus consumer staples. And so typically consumer discretionary stocks will outperform consumer staple stocks in economic expansions in the growth part of the economic cycle. And once again, that's what the market's really hanging its hat on. Because if the market was really worried about recession, we'd see staples outperform discretionary stocks. And we'd also see things like high yield bonds underperform treasuries. But we have the opposite. So it's a bit of a risk on move and positioning in the market, with the spread of inflation expectations ticking down, along with government bond yields, the 2-year at 4.59 and the 10-year finding a little bit of support just above 4.10, and TLT looking a little stretched, short-term overbought here, getting a bit of a bearish divergences happening along with some reversal signals, and high yield bonds, really parabolic short-term move up there. The dollar turning back down again today, and Bitcoin looking a little toppy in the short term. Over to stock sectors, the winner today was Global Jets Airlines, loving the lower price of oil. After that, we got semiconductors on the back of AMD and the communication sector. The weakest sector today was energy stocks, followed by junior gold miners and a little bit of a pullback in utility stocks. Apple's only within 4 points of all-time highs, and we got a bit of a pullback in the defense contractors today. And we got a real nice bounce in Walgreens today, up over 7%, just under $23 a share, and it's looking a bit more likely it may have found support and a bottom around $20 a share here. We'll see whether it can take out these highs from October at $24.60 a share, and some continued nice move ups in the banks here. So there we are on the SPY ETF at $458 a unit. And just looking out to next Friday, when we've got the regular monthly options expiry, OPEX, being the third Friday of the month, we've got max paying quite a bit lower at $440, and that's the price where option dealers will make the maximum amount of profit, with the most amount of options expiring worthless. And so that's quite a bit lower. That's $440 here, which can sometimes act as a magnet in the market. Option dealers are pretty good at getting their way, and like we can see again here in options data, 54% calls, and that's been coming in at 54, 55, 56, 57 over the last week or two consistently. On top of the market flipping back to bullish positioning levels where we last saw some short-term peaks in the market, and we've also got yearly lows and bearish positioning now as well. So basically the market has got a bullish consensus going, and we can see that in the sentiment surveys, indicators, and call option activity. However, the option dealers are going to do a lot better if the market pulls back, which we could get next week. However, I'd say the jobs data tomorrow could set the tone for that. We'll just have to wait and see what happens. But for now, this market is coiling up and getting ready to break in one direction. We could still do a head fake above here to new year-to-date highs. Probably going to draw in a lot more bulls and calls. However, I'm not sure if that can hold. As usual, we'll just have to wait and see what happens and keep playing it day by day. That's all I got for you today. Thanks very much for tuning in to Click Capital, and make sure you come back tomorrow for all my analysis and thoughts on the jobs data print and the market's reaction. Thanks very much. Cheers.